There we go. James.
Thank you so much, Mark. Welcome everyone to DSAI's third quantitative finance talk. We think it's going to be an absolutely fantastic session today with Girish here sharing his wisdom and his experience and enlightening all of us in the world of quant finance. Just as a small less than awkward aside, we recently found out that Girish interviewed me for a position back in 2017. Needless to say, I didn't get it, but it was a wonderful experience. And I think Girish is an extremely clever individual. And I think he's going to really enlighten all of us today. But before we get stuck into that, Mark, you've already introduced yourself. What have we got going on in terms of DSAI's events? And what have our viewers got to look forward to?
Thanks very much for that, James. So I'm here with Arturo, my other co-president for DSAI. The biggest thing that we've got coming up later this year, and hopefully we will have opened up by that stage. So we're very hopeful. The end of November, there's going to be something called Data for Social Good Hackathon. And we haven't got an official announcement on that yet, as we're waiting on a few more sponsors to come on board. But the idea is that for different industries, being finance, property, healthcare, even mining, and even defense and government, we're doing different kind of data problem solving things within that space. And there is prize money, of course, and we'll have high level kind of sponsors in there. So government ministers will have heads of and chief data officers and various kind of people to network with. So it's very much an opportunity to not just win money and solve great, socially good data problems, but also to network and potentially for job opportunities as well. So that's coming at the end of November. So please keep an eye out for that as we make announcements either on LinkedIn, on our meetup page, or our website. Apart from that, Arturo and I have been doing some stuff in the quant finance space ourselves, since we come from that banking kind of background. Arturo, I'll hand it over to you. Do you want to tell the viewers about some of the stuff we've been doing in portfolio analytics, etc.?
Yeah, I'm actually really excited to listen to Girish's talk, and I'm not so sure that I'm adding so much value at this stage. Maybe we can have a conversation actually after Girish has spoken, and we make this a little bit more dynamic instead of just me talking about me. Okay. So please go ahead, Girish.
Perfect. All right. Well, James, we'll hand over back to you to start off the presentation. And yeah, Girish, thank you very much again. Over to you guys.
Thank you so much, Girish. Welcome again to our beautiful chat. So I guess first things first, I'll allow you to introduce yourself, your role, and I guess in a Twitter post, what you do for Bank of America Merrill Lynch.
Thank you, James. And thank you, Mark and Arturo, for the opportunity to speak on this forum. So my name is Girish Nair. I work for Bank of America as a quantitative strategist. I joined the firm in 2004, and this is my 17th year at the firm. Apart from quantitative strategy, the firm just announced me as the co-head of ESG for Asia Pacific region. So I'm looking for a new challenge in my career.
Fantastic. So what kind of analytics work do you do as a quantitative strategist? Like how would you explain that to a 5-year-old? Explain like I'm 5. What is quantitative strategy?
Now, James, the quant strategy or quantitative finance is an extremely wide spectrum or field. On one side, you will find people who do a lot of mathematical algorithms, and they create purely mathematical formulas to navigate through equity markets or fixed income markets. And on the other side of spectrum is any fundamental analyst who is in the field of finance, who is just analyzing companies using traditional annual reports. My team at Bank of America, we are known as quants for non-quants. What I mean by that is most of our clients are traditional fundamental investors who like to have a systematic way of investing or navigating through equity markets. We analyze billions of data points each month to provide clear signals to navigate equity markets in a easy to understand format. What these clients are looking for is it's an objective way, a systematic way of investing in equity markets, and that's what we provide.
Sorry, that's great, fantastic. And what's some of the recent work that you've published? I see you've already got something you prepared earlier. Do you want to walk us through some of the work that you do and some of the work that you've published?
So I'm going to just briefly explain the work we do, because I mentioned that we provide investors another person with an opinion, right? So everyone has an opinion, but data helps you back up your decisions. And one of the things we do for investors or our equity clients is to look at equity markets through a 4 pillars framework. And you see those 4 pillars on the screen there. What we do is the first pillar is called a top-down pillar. It's based on a macro indicator which quantifies the cycle. We call it the global wave. I'll show you the chart later on. It's one of the most well-read pieces across Bank of America globally. The global wave is binary in nature, and I'll just jump onto the global wave. It's truly global in nature, which means it looks at 50 countries in the world. It uses 7 indicators. I'll go through those 7 indicators. And it's a purely quantitative model which quantifies economic cycle. What we found is those economic cycles tend to correlate with equity markets, tend to correlate with sector allocation, regions to invest in, which countries to invest in, which style to invest in, which commodities to invest in, which foreign exchange to invest in and out. So it provides you an economic background by quantifying cycle. We think that cycle is one of the most important things to quantify because cycle drives performance. Stocks in the world, but you might not outperform because you are basically not holding the stocks which tend to do well in certain phases of the cycle. So quantifying top-down macro indicator is an important thing. These are the 7 components which the global wave is made up of. You can see that some of them are forward-looking indicators like industrial confidence and consumer confidence is basically sentiment-driven factors. It's basically based on survey. What we do is for each one of these 7 indicators, we look at 50 countries and then GDP weighted. So there are 350 time series behind this analysis. Some of them are sentiment forward-looking indicators like industrial confidence, consumer confidence, earnings revision ratio. Some of them are real economic indicators like capacity utilization, unemployment. They are a bit lagging, but they are real economic indicators. And some of them quantify how cheap or expensive credit is, like credit spreads. So combination of those 7 indicators provides us the global wave. And that is basically the first pillar of our approach. The second pillar of our approach is called style. Now, style investing has been in vogue in the US for more than 100 years now. And almost every investors we have met in the US and North America, they have an explicit mandate or style tilt. You might have heard value investors or growth investors or yield investors. Now, that has been very popular way of investing in the US. European investors adopted style investing close to 20 years ago. In Asia, the popularity of style investing is still slowly gaining prominence, but it's still nascent. A lot of investors in Asia say that they are style agnostic, which means they explicitly do not tilt towards any style. But what happens is the performance, when you look at the performance of this fund, you then analyze. We do a lot of performance analytics, attribution analysis, and we see from there that the performance of those portfolios can be mostly attributed to incorrect style tilts at a point in cycle. And what I mean by that is investors lose money most of the time, not because of what they are holding, because of what they're not holding. So understanding style tilts, implicit style biases are extremely important. So we monitor 7 distinct styles: value, growth, quality, risk, momentum, yield, small caps. And each month we publish a report which analyzes performance of this style. We recommend style tilts, which style tend to do well at this point in time based on the economic cycle. And then we provide stocks which give you exposure to the style. So the second pillar in our approach is a style analysis. The third one is very obvious: valuation.
Sorry, yeah, I guess that it reminds me of a consultancy I used to work at, where they said their product is based on the John West test for John West tuna. You know, it's the tuna that John West doesn't include in his tins that makes John West the best. In a similar way, the style, you know, it's the products that you don't invest in that make your investing options more valuable, at least.
Yeah, exactly. The third pillar is the bottom-up analysis. And what I mean by bottom-up is it is simply based on 2 major things which drive equity markets. One is earnings, and the second one is price. What this model does, and this is one of the oldest model my boss Nigel Tupper created 25 years ago. It's basically quantifying the behavior of 2 distinct groups in equity markets. One group of people are equity analysts who cover stocks, individual stocks. They analyze the stocks from a bottom-up perspective, from a fundamental perspective, from their products and services. They talk to stakeholders in the companies, and then they project earnings, forward-looking earnings of the stock. So they have a view. We quantify that by looking at how the forward-looking earnings of the company is trending. Then we look at the other side of the equation, which is the other set of individuals which matter the most, which are the fund managers, traders who actually buy the stock in the equity markets. So we quantify price, we quantify earnings. And what we have found is when both of them trend in the same direction, there is information in that. So when earnings trend with price, we have seen that those kind of stocks, sectors, countries, regions tend to do well. When they don't say, when they're doing something different, that's where there is a confusion out there and there is a lot of guesswork. You might have heard investors saying that I want to buy the stocks where the earnings have gone up, but the price has not. But they are missing the point that if the price has not gone up, there is something wrong. Someone is not believing in the story which the fundamental analyst is portraying. So that is basically the third pillar. And the fourth pillar is valuation. Everyone wants to know what they're paying for something at any point in time and whether it's cheap or expensive relative to other assets and relative to its history. So what happens using these 4 pillars is not only we can quantify a country or a region or a sector, but we can quantify a stock as well. Any equity asset can be quantified using this 4 pillars approach. And we publish a lot of research, but we can be summed up into this single 4 pillars approach, which we use to provide recommendations on any equity asset in the world. Sorry, that was a long-winded response to your question, but this 4 pillars framework has been in work for probably 25 years. And that's how that's what we use as the base for any recommendations we make.
That sounds fascinating and quite comprehensive, actually, might I add, that you're looking both at the fundamentals and then you also have some quantitative factors and you also have like quantification of, soft sentiment. It must be like quite a complex model. So another question, digging a little deeper now, what are some of the data science tools and what are some of the methodologies you use to conduct your research within this framework?
Yes, James. And before that, what I'm going to highlight are some of the new research we have published, and that will provide you an outlook on what kind of tools and data sets we have been using. So the recent research in the last probably 2.5 years have been heavy on alternative data. And Mark and I spoke about alternative data set last year on a symposium, and big data. And there are a few reasons for the prominence and the upcoming of the alternative data. Is there are only so many ways investors can crunch traditional fundamental data. So earnings or sales or profit margins or costs, the traditional fundamental factors can only be crunched in so many ways. So investors are now seeking higher frequency data than they had access to, especially after COVID. After COVID, investors wanted to keep on top of higher frequency data, higher frequency changes in the market, so they know exactly if something is happening in any part of the world, how does it impact their equity markets, and higher frequency data helps you do that. Another thing is investors want to have an edge over others. So for example, every investor wants to have a unique selling proposition of how to make money and to outperform their neighbors. And the only way to do that is to use conventional methods of collecting data. So for example, you might have heard how there are data vendors who are basically, they install cameras in the entry and exits of Walmarts to quantify foot traffic, or satellite images to quantify industrial activity, satellite images to track shipping activity, or restaurant bookings to measure consumer demands. So those kind of alternative data sets are in prominence. And one of the first things we did was in 2019, we introduced an analysis called News Alpha. And what we did that is we basically sourced the data from a company called Ravenpack. Now, this is where important decision makes: build or buy, right? You might have got this conundrum as well from companies that should we build our own data set from ground up using machine learning, natural language processing, which is what news has to be dealt with, or should we go with something someone who is already doing that or has created the capabilities of crunching that kind of alternative data set in a more efficient manner. So basically what we found was Ravenpack had a wide coverage of stocks. They have covered close to 50,000 stocks globally. They have data since 2000, so 21 years of data. They use sophisticated suite of machine learning and natural language processing algorithms. And every day they analyze 1 million news events globally, and their average processing time is 300 milliseconds. Now tell me, if you had to do that from ground up, would you ever reach that capabilities, right? So we decided to go with Ravenpack. We used the data set. We had a chat with the chief data scientist who said, you can use these signals from news, but at the most you can only extract alpha up to 3 months forward. So you can use this as a factor for investing, but that factor will only provide you alpha for the next 3 months. So day one, our challenge was to use exactly the same data as Ravenpack provides, but find long-term alpha generating opportunities, because our investors are traditional fundamental investors, as I said to start with, and these fundamental investors have long-term investment horizon, 12 months or more. So what we did is we took the news data. There are a lot of data points Ravenpack analyzes. So they run machine learning algorithms on it. They run natural language processing algorithms to quantify sentiment, to quantify tone, to quantify contextual information. And we looked at that data and said, let's filter out to find a signal which can last long. To find that, we had to basically denoise news. We had to slow down the signal, because news by definition is high frequency in nature. So it took us 8 to 9 months to come up with a signal to help quantify trends in news. And this is what you see. What you see on the screen is called Global News Pulse. It's an indicator we created to quantify trends in news globally. It's a simple ratio of the proportion of stocks with positive significant news divided by the proportion of stocks with negative significant news. It has a 65% correlation with the MSCI All Country World Index. You can see it's a daily indicator. It actually peaked in 2018, just when the trade wars were announced, and then since then it has been trending down. It actually troughed in August last year, and since then it has been trending up. So there are currently 50% more stocks in the world with positive significant news compared to negative significant news. And so we have created such a news pulse for every region, every sector in the world. And when you compare the news pulse by region of the world, US and Europe has the strongest news pulse, while Japan, although there are 43% more positive news than negative news, it has the lowest level. When you compare the news pulse by sector, the news is most significant or most positive in cyclical sectors such as financials, real estate, tech, materials, and it is least positive in defensive sectors. Now, if you have been monitoring equity markets, you would see, if you look at those, if you look at these sectors by any fundamental factors, so like earnings divisions, for example, which is a very common way to look at how sectors are doing, these trends from alternative data relates well with any fundamental data. So you can see that they are both providing very similar kind of results. So we took this a step further and said, what if we use it at a stock level to make use it as a factor for investing? And when we do that, the blue line you see on these charts basically shows a monthly rebalance strategy of investing in stocks with the most positive news and going short stocks with most negative news. And if you did that on a monthly basis, monthly rebalanced basis, on a consistent basis, in the last 17 years, you would have got 8% long short return using news as a factor. Now, when we did that, a lot of our investors said, yes, but what is the turnover? And the turnover was high because news by definition keeps on changing. And as a company is in media a lot and is gaining prominence and gaining more positive news, it might stack up higher in rank, but it can also fall after a few negative news around it. So what we did is we then combined the news with traditional factors, for example, growth, value, momentum, dividends, and said if whether news is in the price or whether there is any orthogonal information in news which is not there in any other factor. Because one of the criticisms we got is news is just momentum, right? So how do you differentiate news with momentum? So we combine news with every factor, momentum, value, growth, quality, name it, and we did that. And what we found is in every instance, news actually added to alpha. And this is an example of combining news with growth. And the thin black line you see there is the performance of the highest growth stocks in the world in the last 17 years. It's again a monthly rebalance, showing a very traditional backtesting, which a quant like us do. It's monthly rebalance strategy where you go long with the highest growth stocks on a monthly basis. And that provides you a certain outperformance. Within that, if you look at stocks with positive news stories, they actually outperform. That was not surprising for us. What is surprising for us is this. These are growth stocks with negative significant news. So that is what surprised us, that even though you might be in the highest growth stocks, if there are stocks with negative news stories, they tend to underperform. That's an annualized performance. And if you look at the annualized performance, growth stocks by themselves provide you 3% outperformance per annum in the last 17 years. Within that, stocks with positive news stories actually add 2.6%. So from 3, it goes to 5.6%. And surprisingly, growth stocks with negative news actually underperform. And this was not just for growth. We combined the positive news with every other factor. And in each instance, positive news stories added to alpha and negative news stories detracted from alpha. And so the conclusion from this analysis was similar to how investors monitor their growth profile or valuation, average valuation factors for their portfolio, or what's the beta of your portfolio. Those things are something which investors keep on top on a daily basis. We recommend investors to look at news and see how, on average, their portfolio is tilted towards news, whether they are positively skewed or negatively skewed. And if there are any stocks which they are holding, which has any kind of negative news, then they need to be wary on that.
Girish, let me ask
Girish,
you.
Sorry, go ahead,
Yeah.
Arturo.
Quick question. You mentioned that your investors were more traditional long-term investors, and therefore even the 3-month alpha that Raven Pack suggested, even that was too short for them. How would these strategies have worked with, let's say, a 6-month or a yearly rebalancing?
Yeah, that's a good question, Arturo. So one thing we did to slow down the signal from the news was to basically, instead of looking daily news items for a stock and making an investment decision based on yesterday's news, we basically slowed down the signal from news. So what we did was, for any month, right? So let me go back to this strategy. At the end of each month, we look at all the news items for a stock in the last 90 days. And every piece of information, whether it's positive, if it's positive, it adds to the overall factor for that stock. If there is a negative news, it detracts from it, right? At the end of the month, every stock has a news pulse rank, which ranks from 100% where all the news in the last 90 days were positive to minus 100% where all the news are negative, right? And if you rank all the stocks by them, we basically take the top quintile of stocks, top 20% of stocks, and then go long those stocks and go short those stocks, right? So your question about the longevity, about how often do you need to rebalance to get a outperformance is quantified in this chart. And what we found is there are certain type of news events which have longer lifespan, longer shelf life than other kinds of news. So what we did is we looked at this data set and we found that news, when you look at different event types. So for example, when Pfizer came out with a new vaccine, it's a new product event type, for example. Or if Apple goes and enters a new market, let's say it enters China, that's an event type. Or if during the earnings season, company reports its earnings and then Bloomberg writes about that earnings estimates of the company, then that's earnings estimate event types. When we look at the event types provided by Raven Pack, there were 7,000 different unique event types. And when we look at the category, when we categorized it, we found that there are few of them, they look similar. For example, if Samsung comes out with a new product, new mobile phone, it's a new product. Well, Pfizer comes out with a new vaccine, it's also a new product. So what we did is we condensed those 7,000 events into 12 major event groups. Then what we did is we said, let's now say at any point in time, there is a piece of news which comes in. And if it's positive and significantly positive, let's look at the 1 day, 5 day, 21 days, 3 months, 6 months, and up to 12 months forward-looking earnings. Forward-looking performance. How do they perform 12 months later? And when we did that across all the different event groups, we found that on the left-hand side of the screen, you can see credit, M&A events, guidance events. Those kind of events do not have longevity. In other words, those kind of events, if you're a traditional long-term investor, those kind of events do not provide you long-term alpha, because from a long-term alpha perspective, they provide you the least alpha. But news around fundamentals such as earnings estimates, price targets, where the company beats earning expectation and they introduce new products, those are the ones actually which provide you long-term alpha. So any point in time, if a stock comes with a new product, you hold on to that stock for 12 months. On average, those kind of news items actually provide you long-term alpha. So Arturo, I'm not sure if I answered your question.
Yeah, no, absolutely.
In other words, we found that short-term investors can use M&A events and guidance events and buybacks to make money, but long-term investors need to look out for fundamental news stories.
One brief follow-up question with regards to the earnings estimate or the price target, for example. You see that long-term alpha, but is that long-term alpha generated very quickly right after the event, and it's a very big jump, and then the performance kind of tapers off towards the last 10 months? So you basically, do you make all your money over the first 2 months, and then what happens in the next 10 months is irrelevant? Or is it like a nice equally weighted, let's put it that way, performance gain across the 12 months?
It's more of a smooth pattern over the next 12 months. And what we have found is that positive news stories around earnings estimates or earnings expectation actually are self-fulfilling in nature, which means, let me give you an example, that the analyst is sitting in front of the, let's say Apple is providing the earnings results, and Apple comes out and says in the next 6 months, they expect this many mobile phones to sell in these certain geographies. And the analyst thinks about it and he writes a new, nice positive story about it. Bloomberg picks it. Now, we are not capturing the analyst reports, right? We are capturing news around that report. So Bloomberg picks it and says, Bank of America analyst has provided this kind of estimate for Apple in the next 12 months, but Morgan Stanley thinks that Apple is going to gain market share, not just because of the mobile phones, but it's also having more service-oriented offerings. You can see that it's now just encompassing more than what Apple is doing or said at that earnings conference. And over the next 12 months, what we have seen is the share price performance appreciates, not just because of the initial announcement, not because of the initial announcement, but all the other things they have done in the ensuing 12 months to make sure their estimates have been met.
That's awesome. By the way, for those of you that don't know, Girish, I worked at Bank of America Merrill Lynch in London as a systematic derivatives trader, although I did not work with Girish because he was here in Sydney. But just put a little bit of context to the entire conversation. Sorry, go ahead.
So that was our first foray into alternative data. Go ahead, Mark.
No, sorry, the delay on my part. I was gonna just move things along. All good.
Okay. So the second thing we did, and it was introduced last year, was something called Productpedia. And the inception of this idea, we spent 2 years building this. And why did we build this? You imagine US and China trade wars in 2017-18. There was a lot of conflict between those two nations, and they were imposing tariffs on each other, trying to reduce the reliance or the interdependence of their sectors. And so a lot of companies, a lot of industries started to think about whether to create in-house capabilities, in-country capabilities for the raw material or finished goods, or should they source it from other country apart from each other? So that started, that made us think, how do we quantify supply chain? How do we quantify the dependence on a product or service at a country? Those who read no standard a company has to follow when they have to report revenue by products. So an example of that is, if you look at the annual report of Apple, they will say iPhone in the sales figure and say this means they derive this much revenue from iPhone. If you look at Samsung, they will say mobile phones. If you look at Xiaomi, for example, they will say a smartphone. So every company uses from their products and services they offer. Use extremely 50,000 companies had 300,000 different products and services within their annual reports and reported data. And so we created basically a database which normalizes this data and groups this information. So traditional segmentation puts one stock into one sector. And an example of that, going back to Apple, is if you look at the global industry classification, GICS, which is what most investors on buy side and most sell side analysts use, Apple falls into one GICS sector, which is tech hardware. That's about it. So if investors want to make investment decisions about tech hardware, they will come across Apple. In our analysis, what we did is, because we grouped these by products, we created a product group called smartphone manufacturing, and Samsung, Apple, Xiaomi, LG, Nokia, they all fell into that group, which means we could segment companies by different product groups. An example of Apple is it falls into smartphone, it falls into wearables, it falls into streaming. It makes actually more money than Netflix does in terms of streaming.
Quick question, Girish, on your research. In the current age of misinformation, and this might be a trivial question, so please stop me if I'm going off track. But yeah, in the current age of misinformation and various news sources, and at times it being difficult to discern the truth from bias, how does Bank of America Merrill Lynch, or how does your, I guess, methodology suite account for a reliable news source versus a unbiased news source? As we can see in North America especially, I think there is a much more obvious divide of left-leaning politically, left-leaning and right-leaning news sources than in Australia, where I think some lean politically one way or other, but most are kind of centered. So how do you gauge that kind of centric view on a news source to get a truly unbiased data source? Or if you accept a biased data source, how do you account for the bias?
Right. So this is going back to the news analysis, and the natural language processing algorithms, the suite of natural language processing algorithms used by Ravenpack is what we have used to basically filter out biases. In some ways, biases are important. Like there are anchoring biases all over the place. For example, people put a number around an estimate and everybody's thinking about that number. Let's say, for example, 1,200 COVID cases were released last night, and now you are thinking that the number would be around 1,200, right? Even though you don't know how many people actually went and stood in the line for the testing. No one knows that number, right? There are always biases, anchoring biases, confirmation biases, framing biases, halo effect, survivorship bias. But the algorithms the Ravenpack has used, they output a lot of different numbers or quantifiable outputs. And the three things we use is the tone algorithms from natural language processing. So whether the tone is positive or negative, doesn't matter what bias is there, we can quantify how positive or negative is the tone within the article. It uses sentiment, so positive or negative words within the article quantifies sentiment. But the last important thing, which actually is unbiased, is the contextual part of the natural language processing. And what the contextual part does is that's where the machine learning has been utilized as well. Is when an article says that, let me make up an example. Bloomberg news article said Bank of America analyst upgraded Apple's earnings by 3% for 2022. What Ravenpack has done, because they have such a long history, they have basically backtested using machine learning as to how a contextual information like a 3% uptick in earnings has helped the share price, eventual subsequent share price of Apple. And they have these numbers going back in time. So what have they done is they have basically put a confidence factor on every contextual information in the news. And so, for example, they would say, an article which says that Bank of America analyst has upgraded the Apple's earnings by 3%. The historical analysis says that 3% earnings is not enough to basically make or create a stock price appreciation for Apple. While if Morgan Stanley has come up and said that the earnings estimate for Apple is now 12%, historical backtesting using machine learning has come up with an answer that 12% uptick in earnings has actually caused stocks to outperform in the next 12 months. That contextual information remains unbiased, and that's where I think what we have used to basically weight the natural language processing algorithms. Fake news does not. Fake news is something which basically spreads among a lot of people in one medium. So, for example, fake news spreading across a lot of Facebook users, but fake news does not spread across multiple mediums. What I mean to say is, a fake news on Facebook will not appear on Bloomberg or LexisNexis or The Fly or Dow Jones indices, which is where most of the news is sourced in real impact. So there are a few ways of filtering out news items, James.
Thanks for that answer, and that's actually a fascinating answer. So thanks for expanding into that. We have one more question, sorry, before you go into the Productpedia, from the crowd. Can you say more about, oh, sorry, this is from Ben. Can you say more about how you backtest the inferred relationships when everything in play is so non-stationary? For example, COVID has had a massive impact. Do we know if all these empirical relationships still hold?
Yes, I also read an article recently on LinkedIn which said you cannot backtest the future, which I thought was similar to saying that you cannot learn anything from your past. Yes, you can learn from historical things. And what we learned during COVID is use the same historical patterns and relationship, but monitor them on a higher frequency basis. So for example, what I mean by that is during COVID, we started monitoring the daily number of new cases in China by province. And we found that, yes, the number of new cases were jumping up in every province in China. And then it started going out of China into the US and Europe. And a lot of times when you're trying to navigate through equity markets, you're always trying to find what caused the market to move, right? So for example, we started publishing a weekly report on these indicators, higher frequency indicators, and providing market commentary, and tried to attribute the performance of equity markets to a factor. Maybe the number of cases in the US skyrocketed. But that's not true, because equity markets are so non-linear in nature. And so what one has to do is, again, use the traditional things. So for example, last week, equity markets were up 2%. Global equity markets were up 2%. Emerging markets were up 4.6%. If you look at all the factors last week, what happened? Earnings were flat, credit spreads were flat. But one thing what happened was Fed came out and provided a dovish comment, right? Now, relationship of Fed to equity markets goes back 100 years. Did that break? No, it did not, right? So I think empirical historical factors still have their place. It's just that how faster can you incorporate that into your decision making? That's the important question to ask.
Thanks for that, Girish. Ben, I hope that answered your question. And Girish, I'll let you go on with your Productpedia.
Thank you, James. So basically, Productpedia provides you more granular approach in stock selection, where a traditional geeks-based classification provides you 160 different sectors. Productpedia provides you 350 different product groups. What do we do with that? We can do things like this. What are the best long-term performing products? Not stocks, not sectors, not regions, products. And you can see that on the right-hand side of this chart, multimedia summaries have been some of the best performing products over the last 8 years of our testing. Streaming services, software for home and offices. And on the other side, on the flip side, watch, clock makers, shipbuilders, farming and crop manufacturers or companies involved with those kind of industries have consistently underperformed. So basically, Productpedia gives you different ways of looking at the equity markets. It's a new product. We are finding it challenging to explain it to clients as to how to use it. And one of the ways is that chart. For example, if you are looking at a technology space using the GICS classification, there are only 13 different sectors you can choose from. But using Productpedia, there are 66 different product groups you can choose from. So it provides you more granular stock selection opportunities. The last product, and which is the latest, we introduced it in March this year. It's called Proximate. And the genesis of this model was a lot of clients would like to invest in assets without directly owning them. So for example, an Australian investor who wants to gain the performance of China market without directly holding China stocks, or an Australian investor who wants to gain access to the performance of copper prices through stocks, not via futures or options, or an Australian investor who wants to gain exposure to a single stock in Japan, let's say Toyota, using a group of Australian stocks. So what we did is we used genetic algorithm here, because we found that genetic algorithm is one of those non-linear optimization techniques which can basically come out with a replication strategy which we have not seen in the past. So it's a complex optimization technique. It's global in nature. It's not linear in nature, which means a big solution space. And I'll give you an example of this. If you wanted to come up with random 50 stock basket to approximate a global index, MSCI All Country World Index, right? You know how many combinations are there? There are one followed by 100 zeros. That's how many combinations of portfolios you can create, random combinations of 50 stock portfolios you can create to approximate an index. And now let's say those 50 stock, you need to calculate the performance, right? And see how they trend with the global equity markets. And if you have to do that using the most powerful computers in the world, if you were going to do that, it would take more than the age of the universe. The age of the universe is 13.9 billion years, right? So it is such a tough computationally and from optimization point of view, it was such a difficult thing to do. And so we came up with basically a genetic algorithm. We found this, and I found this when I was doing my PhD, that a group of paleontologists, when they found pieces of bones in a dinosaur, right? And they wanted to know which dinosaur it belonged to. There were 300,000 different species of dinosaurs. And so how do you find it? And so what they did is basically they used genomes, and they broke the genomes into multiple pieces, and they used this genetic algorithm to basically come up to the classification of the dinosaur, which they wanted to find. And they found that in their testing, 98% of the times, they found the bone belonged to a certain dinosaur group more efficiently than any algorithms in the past. So we thought of using this for stock selection. So things like, so this is some of the reasons why we use genetic algorithm. It's based on Charles Darwin's theory of evolution. It uses a lot of objective functions. It's a multiple objective function algorithm. The objective functions can be discrete in nature or continuous in nature. It can be applied for different scenarios. For example, without much training, it does not provide you the best solution, because the best solution is elusive, right? But it provides you optimal solution. And when I say how did we compare that, we used the most traditionally used Monte Carlo simulation, and we ran 100 million portfolios, which took 3 hours to generate. And we calculated the performance and correlation and different things, and we found that one run of genetic algorithm, which was finished in 3 minutes, by the way, beat 100 million combinations of Monte Carlo simulations. So that provided us the confidence, and that's the example of what it did. So the thick blue line there is MSCI Emerging Markets Index. The thin black line is the 50 stock basket genetic algorithm came up with to approximate emerging market stocks. So this is a common problem we have where a developed market investor wants to gain performance of emerging markets without owning any emerging market stocks. So what we did is we used the universe of developed market stocks, used genetic algorithm to come up with 50 stocks which emulated the performance of MSCI emerging markets. So that has been a hit within our team, within clients. A lot of investors came back and said, can we approximate the ISM index? Can we approximate economic series? Can we approximate aluminum prices using stocks? So we could use that in many different ways to basically help out our investors. So 3 new products: News Alpha using news, billions of news events; Productpedia, the most complex database we have ever created to group stocks by products; and third one is genetic algorithm, showcases machine learning and optimization techniques, basically to help solve a problem investors face.
Thank you so much, Girish. For those that don't know, there's a very famous video floating around on YouTube that was part of my education of genetic algorithms, where the objective function was to reduce the effort and maximize the speed of travel of a kangaroo. Now, all the different, Girish, you're nodding like I think you've seen this video before, where the group of scientists, I think the MIT engineers, they plotted all the different joints and all the different parts that make up a kangaroo by bone structure. And they fed this model into a genetic algorithm, and the genetic algorithm decided that the most efficient way for a kangaroo to travel would be forward flips. Because of the size of its legs and the size of its tail and whatnot, the kangaroo could achieve a maximum speed far quicker if it did forward flips instead of straight jumps. And it's just this magical thing that I think I never really heard of until watching this video. It's I'm not surprised that you achieved such amazing results, Girish, with your portfolio tracking. And I think once upon a time, if a group of investors said, I want to track the aluminium price, but I don't want to hold aluminium, you would have said too bad. But I guess with this technology, it's absolutely possible. That's fantastic. Thank you so much for that. Mark, do you have any follow-up questions for Girish?
We've got a question here from Ben again. Do you want to go through that one?
Yeah, sure. If my chat decides to work. Sorry.
That's okay. I'll
Mark, yeah, you might have to play it up.
So Girish, Ben asks, and thank you, Ben, for the approximate emerging market index plot, what timescale are you predicting on? And does the blue line that one. Does the blue line represent the best prediction for the next time step or similar?
So thank you, Ben, for the question. The blue line there is the actual MSCI emerging market index, a year-on-year performance in emerging market index in the last 21 years. There is no prediction there. The black line there is point in time portfolio generated by the genetic algorithm. So that is that is how the 2 lines are in that chart.
Okay. Yeah. So you've generated.
And you can see that we have created in-sample and out-sample results. For example, in-sample provided 97% correlation, the correlation of the 50 stock basket to the MSCI emerging markets. The out-sample provided 0.92. Tracking error in sample was better, 1.66, but out of sample 2.15 is not bad. And the last one is the difference between the active return, the absolute active return, and in sample provided 1.3%, while out of sample provided 1.7% performance.
That's pretty good. I had a question, Girish. I've actually got a few, but I'll go with the first one. So with all the data, like if someone had access to all this kind of data, and if they had access to the various tools that you use, whether it's just in Python and you've got various data libraries, or if you're using a service like Ravenpack and bringing that in. Is access alone enough to do this kind of thing? Like, or, you know, what are your thoughts on that?
That's a very good question, Mark. And taking your question one step ahead, when we meet clients these days, they are always these days accompanied with a data scientist. So a portfolio manager is accompanied with the data scientist, and portfolio manager will ask contextual questions around our analysis, what works, what doesn't work. And the data scientist will ask, which Python package have you used, or which formula have you used in your analysis, or which optimization technique? And that is the wrong question to ask, because data science is a combination of art and science. Everyone has access to the science part of things, which are the tools, right? Packages, Python is free, open source. You have access to all packages in the world. But that doesn't mean that the person who has access to all the data science tools has the art to create signals. As a quant, my job is to use all the data, but then find the optimal way to create the signal which I can pass it to the investors. Investors don't care what model I'm running, what am I going to call it, proximate or not proximate, which programming language I'm using, which package I'm using. All they are worried about is the signal I provide or my team provides to help them make investment decisions. And creating the signal is more of an art, and it comes with practice, comes with age, experience. Having tools itself is not enough. So having the tools or the data itself is not enough. And this is and the example of Ravenpack. It's what you adhere to, right? Like the chief data scientist using Ravenpack, who works in Ravenpack, said you can only extract alpha for 3 months. You can see that he used the same data, we used the same data, but we could find signals up to 12 months.
How's the actual implementation of the data pipeline? How would that work for a client, and what kind of issues would you face? And issues in this term, I'm thinking about point in time data with regards to macroeconomic data, right? What other things could you envisage being problematic when actually running live money off a workflow like this?
That's a very practical question, Arturo. And I have seen that data has morphed over the last 20 years. So I've been working with data for 20 years. 15 years ago, you know, the earnings estimates provided by analysts. So there are aggregators of that forecast earnings. They're called consensus earnings estimates. There are companies like Bloomberg, Thomson Reuters, which created those aggregates. I remember 15 years ago, we used to look at all the individual estimates for a company. So let's say BHP, right? And there are 25 brokers who are providing estimates for that company. And we would find that 3 of them are stale estimates, 4 of them are using a different accounting standards, 3 of them have not smoothed it properly. So we used to run a lot of analysis, a lot of back processes and cleaning of the data to make the data clean. These days, in the last 2 to 3 years, data vendors are doing a lot of heavy load lifting, right? So when we go to a client and said we use earnings estimate from IBIS, the investor can basically then now trust IBIS to provide them that earnings estimate to make investment decisions, right? To make a live, to go from a theoretical backtesting to the live, if you require all the underlying data sets to replicate. So for example, a lot of our clients actually consume the output from our analysis because, for example, something like a global wave, a single indicator is made up of 350 different factors, and the data is used from 7 different sources. Imagine the cost to acquire that. Imagine the processes you need to have to create that aggregate by yourself and then to implement it on a live trading environment. Instead of that, they will basically give us a call, send us an email saying, can you provide us the underlying data so that we can use that as an input to my investment decisions. I don't want to change my process. I don't want to reinvent the wheel. Just give me the output from your analysis, and I'll use that in my current investment process. That's how we deal with a lot of our clients.
So Girish, I just want to clarify there. So there's no sort of like live stream. It's more movement of data. It's sort of a low frequency type thing, and you retain the IP.
We retain the IP of the derived data. So high frequency data like news, for example, every day there's a million news events which driven back processes, and then they feed us the raw output from their analysis. But we have not used their framework, right? We use the data, we have created a derivation of it called News Pulse, and that's a daily indicator as well. And we hold or we retain the IP for the News Pulse, not Ravenpack. So we never publish or never provide the raw data provided by someone else. We always add value to it, and that's what I get paid for, to add value on data.
So how do your clients consume that News Pulse though? Is it like an API or?
No, good question. So Bank of America until now they have not created a framework where output from models like ours can stream into a client's interface or client's framework. So most of the time we are using traditional means to basically provide the data. The company I know of, Credit Suisse, is the only one I know who have created an add-in called Halt, where one can create data feeds and demand data or have on-demand data platforms. But we don't. We provide data in a traditional Excel-based format.
Thanks, Girish. Your talk's been very informative. Appreciate it.
Girish, from your chat, it seems like you're on the absolute bleeding edge of the market and market analytics. And I dare say, what do you think the future holds for market analytics, alpha chasing, and I guess data science, at least in your field?
James, that's a good question. Although we have started using a lot of this new age analytics, new age tools like machine learning or natural language processing, we still have not scratched the surface. That's what I think. There are a lot to learn about this technology. There's a lot to learn about every iteration of data. There is a lot of opportunities for alternative data sets. So I mentioned, right, satellite images, for example. Recently, I saw a data set where the company is providing real-time movements of ships across the globe. But not only they are providing that, they also provide you the manifest of what exactly is that ship holding, what kind of products is there on the ship, and who are the consumers and the suppliers. Imagine using that on a real-time basis and providing information. It does not just impact finance world, it impacts every other industry. And I'm not sure whether other industries have started incorporating alternative data as finance world has found it. And so there is a lot of opportunities for other companies to start actually leveraging alternative data and machine learning. I know machine learning has been, it's basically old wine in a new bottle. Amazon started using that 20 years ago, and there are a lot of things which came out of it. But I still think we haven't scratched the surface. Quantum computing is something which I'm looking forward. Similar to genetic algorithm, it will basically soup up, turbocharge something like genetic algorithm. When I say genetic algorithm does not provide the best solution, just optimal solution, with quantum computing, it can provide the best solution.
Girish,
sorry, go ahead, Mark.
Sorry, Girish, just on the alternative data thing that you're talking about, just had a quick comment and then a question that's come from the crowd. So alternative data, for the people in the audience that may not know about it, traditional data in the finance space is data that is to do with earnings and share price and market kind of metrics, right? alternative data is what Girish mentioned, like the satellite imagery or the cameras taking images of things, foot traffic. I met a company that was putting sensors outside of Tesla factories back in 2015, 16 to count how many trucks were going past to infer volume, right? So it's things like that. And what Girish had mentioned there, like finance has been the space, investment banks and hedge funds and the really big place that can afford very expensive data. They were the places that were using this and paying for it. Other industries, we've started seeing it a little bit, but it's still very nascent. So over in the US, the alternative data industry, places like Eagle Alpha that will aggregate a lot of this data and make it available, they've only just maybe in the last year or two started selling to corporates. So it is very valuable, as Girish kind of mentioned, and there's many industries that can take advantage of that. So if you have a think about whatever industry you work in, whether it's healthcare or property, there's probably data that is traditional to your industry, but there's also this alternative data that you may not be utilizing, and whether it's government ABS statistics or weather or something like that, all of those things could be considered alternative data, and maybe you have to piece it together. Maybe it's news that you can get from something like Ravenpack. Going back to the question, so it was the comment, sorry, very long-winded comment. A question from Ben was about Girish. Does Bank of America Merrill Lynch, does that foster any connections with academia that are working in these fields to stay ahead of the curve? Do you have any ongoing kind of relationships with universities or anything like that?
Thank you, Ben, for the question again. I am not sure about any official relationship Bank of America has with universities or academic institutions. But one thing I know, because I just finished a PhD early 2020, and I did not take advantage of my position in Bank of America to do statistical analysis because I have access to the world's best data sets. But I had to go through the academic medium to get access to data sets. And one thing I saw, which was very distinct and which was a bit shocking to me, is through academic circles, you don't have access to the same quality of data as you do from the professional network. What I meant to say that if someone was doing I was doing PhD in data science, but if someone was doing a PhD in finance and said you needed to have, let's say you wanted to prove that high dividend yield stocks do not provide you or provide lesser returns than high growth stocks in 25 years of backtesting. For that to happen, you need access to growth metrics of every stock in the world or the region of your concern, the market data behind, index, a lot of different pieces, and then the tools to crunch the numbers to do that, right? And what happens is in academic circles is whatever is freely available, you take that into factor that into your model, and then you create conclusions by extrapolating that data across multiple years. So in other words, what I mean is I take academic results or academic papers with a pinch of salt. There are good ideas, but unless you have the professional data and the professional rigor to test those academic ideas, I would not blindly follow or adopt an academic idea. I'm sorry, I know there are a lot of people I know who just read academic papers and then have a twist over it and then publish that in the professional network, but that's not what my experience has shown me.
Okay, that's good. You know, just on that topic of academia and stuff, maybe this is a bit of a on-topic, kind of off-topic question, but one thing that I had seen with a lot of that, and maybe it's also to do with backtesting, Girish, you know, a comment I got from a client when I worked in the industry was, and this is a hedge fund client in New York, was he has never seen a bad backtest. The reason, because everyone who shows their data, whether it's Ravenpack or any other kind of provider, always showcases the best data. So obviously you never see the bad results. And I guess
I've also heard that actually.
Yeah, there you go. And I guess it's similar in academia. So sorry, someone say something?
I have an answer for that.
Yeah, go ahead.
No, I have an answer for that, Mark, and I have heard that as well. So in the last 17 years, if I count the number of models we have published, I would say close to 500 models we have published, and each one of them is backed by a backtest. You know how many models we did not publish? Close to 50,000 models we did not publish because they did not work. Why would I publish something which does not work? Why would I come up with a signal which does not work? What's the value add for that hedge fund investor when I say to him that investing in high dividend deals does not work? And this is the chart to prove that, right? So we showcase the best models, but do a lot of investors come back to us and say, you know what, I like your model, but what if you were going to pick the highest dividend yield stock? Backtest that for me and come back to me with an answer. And we do that and say this does not work. So there is probably only 1% of what we publish works. The other 99% does not work. And we spend time in trying to find what works or what does not work. We fail a lot of time, but we will fail faster.
Perfect. No, that's really good. We've got a question from the audience from Richard on computer vision products. Are computer vision products high priority in relation to alternative data models? What do you think about that, Girish?
One of the only examples of utilizing computer vision in finance was the satellite imagery I mentioned earlier. So where there is a dearth of a data set. So for example, China stopped publishing the ISM index, their services, the manufacturing index a few years ago. That's when I was working in Hong Kong. And so suddenly global investors were, they did not have an answer. How is the manufacturing going on in China? And so this company in the US, they came up with this solution where they took 1,500 photos of 1,500 different facilities in China, manufacturing facilities in China. They took two different images, one a daytime image. A daytime image will show smoke coming out of a factory. The nighttime image would take thermal imaging, which means if the company is if the manufacturing facility is humming or there is an activity, it will show the heat, it will show red images, right? So it used two photos for every manufacturing facility on a daily basis to just count the number of factories which were running. So you basically can create a ratio, right? Number of factories which are working divided by the total number of factories. And so it created a proxy manufacturing index using satellite imagery and computer vision, basically to quantify an economic variable which was difficult to understand. And that's a practical example of computer vision. And I want to see more and more of that. And I think we'll see more and more of that, like the foot traffic, for example, or the number of cars going in and out of a car park in IKEA, for example, or the propensity of someone stay inside. Let's say Toyota went inside the car park and they stayed there for 3 hours versus a Land Rover which went in and out quickly. If you can quantify those kind of information, that can provide you more insights. But I haven't seen many other practical examples within the finance space of using computer vision.
That's awesome. I hope that. I'll go ahead, Arturo.
No, I just wanted to say that another example that I implemented myself was the analysis of satellite imagery of vessels to be able to track and effectively predict the trade flows between countries by knowing where these vessels come from, what ports they hit up, how long they're there, see if there's any traffic or any issues with regards to the supply chain, let's put it that way. And commodity funds make a lot of money off that. So there are multiple levels in which there's implementation of computer vision at some stage, let's put it the way, of the workflow. But typically, I would say that is done specifically by people that are very good at that type of image identification, and then the information taken from that identification of the image is passed through other types of quants, let's put it that way. It's very seldom that a quant will build up a computer vision algorithm or workflow and then put that into their actual decision-making process.
Yeah, I think Nearmap are doing something very similar. They're doing the engineering side and then passing that data on and saying, look, guys, we have all this beautiful information. Please buy it off us and do what you want with it. I think their main client at the moment is defense. But yeah, I completely agree with that, Arturo. Sorry, Girish, do you have any comments before we go to the next question from the crowd?
No, James.
Yeah. So we've got one question from Ina. Just in relation to the last product presented, some funds have implemented ESG policies, including avoiding investing in fossil fuels, etc. Has there been interest to replicate returns of oil industry with ESG-friendly portfolio? Now, I think we're having a very exciting event at the end of the year, as Mark alluded to. One of the questions that we're looking at tackling is transition risk, specifically. How do big corporations, specifically in Australia, based on experiences worldwide, transition their current portfolio to non-fossil fuels? Now, presumably, in the future, fossil fuels will produce lower returns than they will today, and environmentally sustainable products will produce higher returns than they do today. Presumably, again, with the flow of money and various regulators around the world. So how has your clients' appetite been, I guess, and how has Bank of America Merrill Lynch responded?
Yes, so ESG is a big space of concentration within Bank of America, and also it's not just the fund management side of things, but every industry is trying to create processes, manufacturing or services which is sustainable. That's what I use. Sustainable businesses. So you can't have a paper company keep cutting the trees, because one day there will be no trees to cut, right? So is your product or your service is sustainable or uses sustainable processes? The question, I think, was more about, can Proximate be used to replicate an energy index using ESG stocks? Yes. So all Proximate needs is, what is the underlying index you want to replicate, and what are the stocks you want to use to replicate that? So if I say replicate oil using ESG friendly companies, Proximate will do that. But what is important to understand is what are the factors which are driving this ESG? To that, I don't have an answer yet, because I was just named the co-head of ESG a few weeks ago. Have not done testing. We just acquired few ESG data sets going back in time, 15 years of ESG data at stock level. So I'll be creating models around it. I want to have a scientific approach towards it. I'm reading a lot of articles. For example, even scientists are actually refreshing their knowledge about how our Earth works. So, for example, IPCC, which is the international group of global countries which came up with this analysis recently, was that coal, for example, burning coal in the atmosphere has actually helped pull down the temperature by 0.5% per year in the last 20 years. And if you try to understand that, aren't we all stopping coal companies, or are we not stopping Australia from exporting coal? The reason why that is when you burn coal in the atmosphere, it releases something called sulfate. Sulfate actually bounces back the sun rays. Sun is the single most component in the entire universe which heats our planet. Not human transmission, not anything else. Sun is the biggest component. And the sulfate was bouncing back the sun rays, which was actually keeping the earth cooler. But what happens with sulfate is when it goes into our lungs, it destroys our lungs, right? So it's bad for us. So scientists came up with this approach saying, let's not release sulfate in our immediate atmosphere, but let's go to stratosphere and release sulfate there to bounce the sunlight off. So you can see that we are actually upgrading our knowledge base when it comes to ESG, because all the knowledge base we have formed around this ESG can be traced back to 1950s, right? 60, 70 years of data. Before that, we don't have much data. So the more we analyze, maybe ice caps in the Arctics or other things, the more we understand about our own Earth, and the more we can make informed decisions rather than jumping onto a bandwagon of ESG.
Thanks for that, Girish. We've got another question from AJ. Girish, you mentioned the leaps that quantum computing could bring to your analytics. Do you foresee any future improvements in classical computing, such as improved hardware, to have a significant capability improvement on the analytics?
Definitely. Cloud computing has been a game changer. I remember 15 years ago, I had one machine with one processor with probably 4 GB RAM, I think, if I was lucky. And then a few years ago, I had multiple machines with multiple CPUs running on that. But still, when the first time I used the cloud computing, which was scalable in nature, and when I saw running an algorithm on a cloud computing, it was on demand, using more processors and up to 8 processors at a time, 128 gigabytes of RAM. And you can imagine that cloud or distributed computing just was a game changer. What you could not do on a single machine, you could do it on a cloud, on a cluster, and you can parallel run your code, right? You can see in Python, for example, you can literally parallelize your code very easily. And that parallel computing has changed a lot. And I see more and more of this being used. Cloud computing is the one I think we can utilize more and more to do the sophisticated analysis like genetic algorithm.
Just one more question from me, actually, on the topic of what the future holds for us. Do you have any bold predictions for either the end of this year or the end of next year that you're, I guess, looking forward to, be it in scientific developments for computing, or be it research that you've seen undertaken for different methodologies in your space?
James, I don't foresee any major change in terms of the technology we are using or the data we are using, or any scientific breakthrough whatsoever in terms of finance and how we crunch numbers. In terms of recommendations, I can see that China has struggled in the last 18 months. It stood out as one of the best looking region for us, but it has not performed well because of the regulatory issues and all the issues around trade wars and things like that. But if you look at China, there is no country at present in Asia with greater intrinsic value, greater growth potential, and greater demographic factors which are working from them. And I think by the end of this year, China is going to perform well. That's from a recommendation perspective. From analysis perspective, I don't think there is going to be any major change by the end of this year.
Thank you so much for that. Mark, do you have any follow-up questions?
No, that was great. Great questions from the audience too. So thank you very much, everyone. I just wanted to say again, thank you, Girish, for providing your time and very insightful to see the products we've spoken over the last couple of years. So Girish and I met when I was working at the ASX, and I think this is, we'd spoken about some of the things that you were working on, and I think I'd seen a little bit of some of the stuff that you'd worked on, but this is the first time I've kind of seen this year everything all pulled together. So this was great for me. I learned a lot.
Oh, thank you, Mark, James, and Arturo for putting me in front of this crowd. A lot of questions. I loved it. And you all know where I am in terms of my digital presence. Feel free to shoot emails or send me a chat message in LinkedIn.
Yeah, and I will make the links like that available in the show notes when we put it up on YouTube. And for everyone, I'm typing it in. I'll actually put the link in the chat now, but if you search DSAI Sydney on YouTube, we've not got many videos just yet, or many subscribers either, but please do subscribe, because we'll be adding this one in so you can get the notifications. And we're going to have more events. As I mentioned at the start, we are doing a Data for Social Good hackathon, which is planned for the end of November. Hopefully that will get off the ground, because given COVID restrictions, who knows where we'll be. But if it is delayed, it will be early next year. But the plan around that is there's a finance stream and different industries with people working on all cool sorts of things with data. So, and Girish, we might get you involved there.
Yeah,
all right.
Well,
definitely,
I guess, Mark, we should wrap it up there and leave our lovely viewers and, of course, Girish to enjoy the remainder of their evenings. I'm sure we'd love to hear more from you, Girish, and I think there'll be 1,000 questions pop up after this. We might even have you back for another chat. I personally found it fascinating. Yeah, so thank you again. Can't thank you enough for coming on, speaking to us, sharing your wisdom, sharing your experience, sharing the beautiful product suite that Bank of America Merrill Lynch has for its clients and the ways that you're solving your clients' problems. Yeah, thank you again. Looking forward to chatting to you next time. And thank you again to everyone that came and joined us.
Thanks, guys.
Thank you.
Yeah,
Thank you.
bye-bye.